What's going on, YouTube? Thank you for watching this YouTube channel. My name is Matt. My company is called the DeRosa Group, and we offer real estate education all over YouTube for you guys to watch and learn from. Now, a lot of you guys that are watching our YouTube channel or that are real estate investors want to know, how do I get my bank happy? And how do I get a bank or a private lender or a hard money lender to work with me and that? So what I've decided to do is I've reached out and I got a lender, right?
Yes.
This is a money man. He's actually got money in his pockets right here. He puts a lot of money into a lot of deals. This is Christian Pepe, and Christian is going to, I jacked up your, there you go. Let's get you better. Okay, cool. Christian is a lender, hard money lender, and also a bank lender, and has done a lot of deals of his own and that. So he's going to offer us a lender's perspective on deals. Which I'm super excited to get into this conversation with you, because a lot of us have to try and guess what a lender's going to think of our deal, and just we have to kind of assume what lenders are thinking and everything like that. So sure. I'm excited. So tell us a little bit about yourself and about your company and just the qualifications you've got to have this conversation with us today.
Sure. First of all, appreciate you having me on. The company I'm with is First Equity Funding. I'm a managing partner there. We are a hard money asset-based lender based in New Jersey, and essentially we focus on lending to investors, whether it's investors doing needing short-term money for to fix and flip a property, or needing longer-term capital for rental properties that they want to hold on to, and that's really our main focus.
Okay, this is something interesting, and as I've heard this term used a lot, and I want our YouTube channel to hear this and define it. What is an asset-based lender? I've heard that term used. So let's go there. What does that mean?
Yeah. So honestly, it's a term I like to use as an alternative to hard money, right? I mean, you hear the term hard money, I feel like it's a scary term for whatever reason.
Yeah, it makes you deal in business with Tony Soprano or something like that.
And you think, and historically, going back 10 years ago, that was what it was. I mean, it was more of a bailout loan. So, and that's really not the premise of what we do. So when I say asset-based lending, I'm more or less thinking, our lending, a borrower has to have certain qualifications from a credit and background and experience standpoint, but it's really about the project, right? Yeah. It's the asset itself. Where they're buying it, what they're putting into it, what the resale is going to be, or the cash flow if it's a rental property. Does it all make sense? Mm-hmm. That's what we kind of mean by that.
Yeah, so you're still looking at tax returns. You still want to see, you're still going to run credit. You're still going to do all that. But if they've got, in my estimations, I've said okay, if I want to go to a local Wells Fargo or a local bank and borrow money from them, I'm going to have a squeaky clean track record, and everything's going to have to be on point all the way up to here.
Absolutely.
Is it safe to say that to work with an asset-based lender, that you don't have to be 100% on point all the way across the board? You guys are able to accept that we're entrepreneurs, we're going to have some blemishes, we're going to be a little scrappy,
It's the whole reason we exist. I mean, my background for 15 years has been in traditional lending, and I still do a lot of that. So I know the checking off every particular box that you need to qualify on a conventional loan. So these are, what makes sense? What should we be looking at? Does it matter if this investor has 5 LLCs and some of them are new, and they're not showing a lot of money on the books yet, they're never going to get approved for that traditional loan. But should it matter? I mean, if they have a ton of experience, the project makes sense, let's do this deal.
Yeah, okay. But if somebody's got a lower credit score, maybe not a 400 credit score, but like a credit score that's like in the low 6s or something like that.
You hit the number right there.
Work that out. Yeah.
600 and better is kind of the same category for us. You know what I mean?
No way you're getting a bank loan at 600 though. You know that, right?
And even if, and then the other thing too is with what we do is, even if you are a bankable borrower, the house may not be bankable, right? So even if you're perfect, if that house needs work, you go in and you walk in and there's literally no kitchen there, it's gutted, the ceilings are falling in, you're going to have a really hard time getting that bank loan, even if you are, quote unquote, bankable.
And I've also found that the velocity of money is better in working with an asset-based lender. And I know you guys might not be able to, produce the money in a day or something like that, but a bank in this day and age, given all the regulations that banks are subject to, you might be looking at 60 or more days, 60 to 90 days to get the money turned around, where you guys can probably turn the money around and let's just say shorter.
Listen, on average, we're 2 to 3 weeks from start to finish, and we kind of say we're the next best thing to cash. You know what I mean? You're still going to have a contingency in the contract that you're getting financing, but we'll let you buy that property as is. We'll provide you with a proof of funds. That way, it's all about speed to close is what's going to get investors, that first look at those opportunities.
Yeah, that's great. So tell me, let's help me further to get inside the head of a lender and everything like that. And so, and I get you've got a background. You've done some fix and flips yourself. You've done some rental projects. Tell me, so from a lender's perspective. let's talk about a fix and flip, okay? Tell me a fix and flip that's a no-go, right? If you're looking at a fix and flip and an investor brings it to you and you're just like, listen, assuming that the investor themselves is okay. Like, yeah, they're qualified, right? So they're going to meet your minimum standards or anything like that. Tell me a deal that's like, no, I can't. So for a fix and flip.
Yeah, so I mean, obviously we're looking at return on investment, for that investor. So, if we're, somebody's buying something, to use an example, for 150,000, they're putting 50 into it. So they're all in numbers 200,000. I mean, if that repaired value is only 225 to even 250, you know what I mean, then that's not gonna work.
Little lean, just figure marketing costs, carrying costs.
Yeah, you want to make sure. And look, we are big on repeat business. We want people having a good experience. So we are looking at, for newer investors, we want to see the total amount that we loan in like that 65 to 70% of as repaired value. And for experienced investors, we'll give them a little bit more leniency and go to 75%. So I mean, that's something. But in terms of we get a lot from honestly just doing a Google Street View of a property. You go and you look what's going on in this neighborhood. Does this house make sense? Is it a total? I was on a podcast earlier talking about outliers. If it's something that's not conforming to the neighborhood. It's interesting how. So we do some kind of back end analytics on zip codes. So when an investor brings us a deal, and I think this is helpful for them, is we'll on a monthly basis, we pull in days on market for that zip code, median home price, and home price appreciation for just that zip code. So if the median home price in a neighborhood, and this is interesting because this has actually been attributed to some of our defaults, if the median home price is 200,000 and you're bringing a house to market for 400,000, it's kind of an outlier to the market. So little things like that, we're looking at.
So outliers, and this goes to you guys too, for you guys watching, is that you don't want to do that deal he just talked about, right? Not just because he wouldn't do it, but because if you go to put a house where the median home price in the area you're dealing is 200,000, and you're like, oh, but Matt, wait, it's got extra bedrooms, and no, wait, it's got a pool and it's got a garage. The problem is that a home buyer is not going to buy that house for 400,000 because for 400,000 they could buy a couple of towns over in a different school system or a different asset or different amenities, different whatever. You're in a different neighborhood class, and so it's going to be a different price point, right? Sure. Regardless of the amenities that you offer on the house. So don't get caught up in this house is so much better, this house should sell more. Look at the overall value around it.
Don't want to be an outlier. And then home price appreciation is are they appreciating? Are they stable? Are they declining? You know what I mean? If you're buying something that in a declining zip code, you may be bringing it to market and it's worth less than what you thought it was. By
Where
the
do you
time
guys get this data?
So we actually, Zillow, believe it or not, has a lot of back end.
I thought you might say that.
Yeah, I mean, it has all these back end analytics that you can extract, and it'll literally by zip code you can pull in. And we look at HPA, we look at days on market, and we look at median home price. So home price appreciation.
Yes.
So is that market appreciation? Is it stable? We just don't want to see a major drop off. And again, if it is, doesn't mean we're not going to lend, but it just means we might want to look at that, just a little bit more granular and kind of dig in a little bit more.
So let's say somebody comes in, and again, seasoned investor, and they're like, okay, Christian, I'm going to go buy this property for, like you said, 150. That same deal, 150,000. Put 50 grand into it, right? How do you verify construction costs? Like, what if they say, we're going to tear this whole place apart and add a level and rip the roof off and put in a kitchen and 5 bathrooms and redo the driveway, and it's only going to cost me $30,000, right? Like, how do you verify?
Yeah, that's a really good question. So, I mean, we kind of break things up into 2 categories. We look at things as basically what we call light rehab versus heavy rehab. Heavy rehab to us is anything where the construction cost is more than what they're buying a house for. So if they're buying something for 100 and they're putting more than 100 into it, we consider that heavy rehab. Or if there's, to your point, expansion. If there's expansion, it definitely is a little bit of a different category. Adding square footage, the pop at top where you're adding a level. And again, we do it. We definitely do. We do a ton of it. And honestly, I think those are some of the type of projects that people need to do nowadays to really add value to the property. But what we'll do is we actually do more of what we call like a feasibility review, where we'll have a construction expert review that scope of work and say, does this all make sense? To your point, adding a level.
So you guys have somebody on staff that just looks at those numbers to say
that is looking at all those things.
So they can't tell you it's going to cost $2,000 to redo this kitchen. You're like, wait.
Now listen, nothing is hard and fast with us. I mean, that's kind of what I love about our thing is that, in the traditional world, it's either like you either check off this box and it fits or it doesn't. For us, it's definitely more qualitative. If somebody is the contractor, they're the investor and the contractor, well, obviously they're going to get the work done cheaper, and we'll give more, leniency there, that, we understand that they're not going to be paying retail prices. Yeah. So we do look at all that.
I want to touch on one thing, and that's because I think that a lot of people that are not investing in New Jersey might not be. It's very common in New Jersey, something called a pop-a-top, right? Yeah. And we see a lot of it here in New Jersey, and I think you guys are going to see more of this reno concept in other parts of the country as things continue to get more competitive, as more density comes in, and that. So just briefly, what is a pop-a-top?
Yeah, so pop-a-top to me is, basically, or you'll hear people talk about the Cape to colonial conversion, So you have, especially a lot in certain towns in North Jersey especially, have Cape Cod style homes, which is basically, you have the roof line. It's kind of, if you have dormers, you have some livable space, but it's low ceilings, or maybe it's just attic space. So they'll literally pop the top. They'll cut the top of it off and they'll add a second level and make it a colonial, so a lot more livable space. Or, and I've done this myself on a deal down the Jersey Shore where it was a Cape, but it wasn't livable. The ceiling was too low. So, sometimes you literally pop the full top. Other times, in my instance, we were able to just dormer things out, make it functional, make it a master bedroom with a bath, and you're adding real functional.
You can make it real functional houses because not, 50 years ago, 1,000 square foot of living space was okay. Yeah. That was practical. Not many people want to own a home with 1,000 square foot worth of living space. So It's not really marketable these days. So you need to add that level to add more square footage and everything like that. So for other parts of the world where you guys have real estate that you've got homes that are just functionally obsolete, consider what Christian's talking about of just like cutting the roof, adding it. And there's certain areas where the construction cost will warrant that, certain areas where it won't. I'm familiar with the pop-a-top concept, but again, I'm from New Jersey as well, so I know what you're talking about, right? Give me any other do's and don'ts, like where just give me like maybe a couple of do's, couple of don'ts, as people that are watching the fix and flips, and we can also get into talking about the rental thing as well, because I know you guys do rental product as well. So
the biggest thing with a flip, I mean, the number one thing that I would say to people is make sure you finish the project 100%. So many people, you're dying to get the house to the market. You're worried about getting your capital back, and you get that project 99% of the way done, and then you look. You could go on Zillow or go online and see houses where they take professional pictures, but there's still tools sitting in the background and stuff like that. Or you go into the property and you open up the cabinets and there's sawdust and there's screws and it's not clean.
They've painted it,
or you've done everything on the inside and you've given zero consideration to some curb appeal or whatever. And I just feel like those little things, you're a first-time home buyer, first impression, that whole thing, you go in there and it gives you a feel like maybe it's some shoddy work or it just wasn't finished the right way, and it could give just a negative impact. So just take that extra time, get a cleaning crew in there, do professional pictures, all these things that you think are logical, but sometimes people just, forget a little bit.
So do get it 100% done. Not 99 versus 100% done is a huge, it is miles of difference in getting a house done. So, okay, great. So do get it 100% done. Any other don'ts that you think they should do? Either don't do the deal or don't present it to you unless they do certain things.
Yeah, I mean, just don't try to hide things. Like for instance, and this isn't even just for me, for a lender. Well, it is. I mean, obviously be transparent with us. We're trying to find ways to make deals work, not try to kill deals. But even if you buy something that has some real issues, right? So a property that where it says there's structural issues or mold or whatever the case may be.
Underground oil tank.
Underground oil tank. Just whatever you like, those buzzword things that are such sticking points. Like that information, it stays out there. So people can research and look at the old listing and see that it's there. And if you just kind of cosmetically take care of it or don't handle it the right way, take things head on. If there was mold, get it remediated the right way. If there's structural stuff, have a structural person, whether it's an engineer or architect or whatever, so that way when the agent who brings the buyer comes in, you could show, look, yeah, of course that was there, but we handled it the right way. We didn't just kind of slap some lipstick or paint on it and just take care of it. So
don't sweep things under the rug, whether it comes to you guys or to your end buyers or whatever. I think that it's from an integrity standpoint and also reputation. But at the end of the day as well, people will eventually figure out if you sweep something under the rug when you're doing it right.
And they will, and it'll come up after it's under contract, after the home inspector comes out there and then just rips it apart, now it's coming back on the market.
And then
so
you
that
lost
whole
2
penny
months.
wise dollar foolish, and then agents are saying, why is it back on the market? Was there an issue? You know, and then it just things start to spiral.
So for your company, you guys offer you do offer long-term rental product and you offer fix and flip short-term funding, right?
Sure.
So how are you able to make that work?
Yeah, so basically, you know, we have the short-term, you know, fix and flip has definitely been our bread and butter for the last 4 or 5 years. That's where there's been the biggest need in the marketplace, so that's definitely been our focus. So now we have this longer-term rental loan for investors, and the same thing, like that self-employed borrower or somebody has different LLCs or for whatever reason is just not bankable. We came up with a product that focuses more on the rental income for the property and less about that borrower's personal financials. So we don't even ask for the tax returns on this rental product.
Whoa.
So it's all about, and you can keep it, it's a 30-year fixed loan, keep the property in the name of an LLC, which is obviously another thing that's really important for investors. And all we're looking at is that product's a little bit more credit score driven. So we want to see a little bit higher FICO on that product because it's a longer term loan, but we're really looking at the cash flow. So, you know, the DSCR, the debt service coverage ratio, we want to see if the PITI payment, so the principal, interest, tax, and insurance, if that's $1,000 a month, ideally we want to see that you're getting 120% of that. So if the debt is $1,000, the rental income's $1,200, that's the main thing we focus on.
Yeah. Okay. What's the? I mean, again, today's September. It's September 2019, so I know rates change.
Sure.
Somebody could be watching this a year from now, right?
Yeah. No.
But what are the rates today?
Yeah. Just to put it into perspective, I mean, so like on a traditional conventional loan for an investment property, and again, this is not talking APR. I mean, just really talking just general terms. You know, interest rates are going to be in the high 4s to low 5s for that bankable person who's going to get run through the ringer. Our rates are in the high 5s to low 6s on a 30-year fixed loan. So 100 basis points or so, a little bit higher.
Maybe 1% more, but what the return that you get for that is you're getting a 30-year fixed loan. You're getting LLC holdings, so it doesn't have to be in your own personal name.
So you're getting those tax benefits, and truthfully, you're actually going to get the loan, and you're going to actually get qualified for it.
Is it around the same loan to value, like around 70?
So no,
70,
we'll actually, so on a purchase, we'll do 80% on a rate and term refinance, and 75% on a cash out. And we'll do cash out after only owning the property for 6 months, which is a huge thing, and off of new value. So if you bought that property for $150, put $50 into it, and now it's worth $275, we'll give you 75% of that. So a lot of investors are able to recoup all or most of their money, and then that way they have no basis in the property. It's cash flow, and they can move on to the next one.
It's great to work with lenders as a real estate investor. It's great to work with a lender that really is able to handle the project full cycle. So if you guys are doing the BRRRR strategy where you're buying, renovating, renting out, refinancing a property, and then you want to refinance it, you know, up until now, you could work with a you know, an asset-based lender that's able to handle the acquisition renovation side of it. But then once you're done that, you're going to take it to a conventional bank, have to take it to a small community bank, which might take you 90 days to close, whatever it is. But you guys are able to handle the project, you know, cradle to cradle.
Yeah,
you know, take it all the way through.
We have the information. We're familiar with the project. You know, our loan officers take a really hands-on approach, getting to understand the project, get to really know our clients and what their needs are, and we're really excited about it because it's really kind of completed what we are offering.
Yeah, that's really attractive. Cool. Yeah. So if people want to hear more about your company or you personally, whatever, how do they tell our YouTube channel how to get a hold of you?
Yeah, sure. So our website is www.fefunding.com. If you just look up First Equity Funding, we're on Twitter, we're on Facebook, we're on all the social media channels.
First Equity Funding. Okay, they can look you up, Christian Pepe.
Yeah. If you just Google Christian Pepe at First Equity Funding, you'll find me.
Cool. All right, great. This has been a great conversation.
Yeah, thanks so much.
There'll be some more on Christian in the description on this video if you guys want to reach out to him and have a conversation with one of your projects or pick his brain a little bit more about what a banker when they look at a project, just what their perspective is going to be. So cool.
Yeah, I would love that. Feel free.
And where do you? Sorry, one more thing, because people are watching this nationwide. What states do you guys work in?
Yeah, so we are based in New Jersey. The bulk of our lending has been more in the tri-state area, New Jersey, New York, Pennsylvania. But we lend in 40 states throughout the country. Mostly East Coast to date has been the bulk of our lending.
Okay, great. So if somebody's watching Florida or whatever, other states up and down the East Coast.
If you go on our website, it'll show the states that we lend in. But by all means, just call me, email me.
So 40 states. You got like a, you know.
It's the bulk of them. There's
got 80% shot.
Yeah, there's a few states out west, California, Nevada, Arizona that have some specific licensing requirement. But other than that, mostly East Coast, we're good.
Okay, great. Yeah, great guys. So reach out to Christian if you got some more questions on that. It's been a great conversation. Thank you so much for being with the channel.
Really appreciate it. Okay.
Thanks for watching, guys. Have a great profitable week.